What's going on, everybody? It's Stas here. Hope you guys are doing well out there, having a great weekend. I just wanted to steal about 5-10 minutes of your time today and go over something that I've been thinking about, quite honestly, for a couple of weeks. I'm not sure why I didn't make this video a couple of weeks ago, but screw it. We're going to make it right now and talk about something that I believe is a mistake. A lot of people are making this mistake in the stock market right now because maybe they're chasing the big returns. They want to get rich. Maybe they think the stock market, and don't get me wrong, I want to get rich too, but it's not, the stock market is not a get rich quick scheme. Over time you can get rich, but I feel like a lot of people are looking at the market right now and they're like, let's get rich quick. And I want to go over this mistake that I believe people are making. And it's evident here in the market that the S&P's at all-time highs. We have the NASDAQ 100 at all-time highs, the Dow's at all-time highs. So a lot of people out there, most of you should be doing well, right? Your portfolio should be up. You should be making a lot of money, at least on paper, or maybe if you're locking in the profits, you're making realized profits, right? Realized gains. And a lot of people, most people are making a crap ton of money right now, right? But there's a lot of people, some people out there that are down. They're not making money. And I know this because I run a YouTube channel. I have a community, right? Thousands of people leave comments. We talk, all throughout these different platforms, Twitter, Discord, YouTube, obviously in the comments, Instagram DMs. I get a lot of people on Patreon. We're talking as well. And a lot of these people, they're too heavy. And this is the mistake here. We're going to get right to the chase, guys. The mistake here is a lot of people, some people are too heavy in SPACs. They're too heavy in the high growth, hype, YouTube, meme stocks. And they're wondering why they're down these past couple of months. And I see a lot of these YouTubers making videos and I laugh to myself. I'm like, how the heck are you guys, they're saying, oh, the stock market's crashing, everybody's down, we're losing so much money. And I'm like, what the heck are you talking about? The S&P's at all-time highs. The Dow's at all-time highs. NASDAQ 100's at all-time highs. What the heck are you talking about? And then I'm thinking to myself, it's because most people, not most people, some people are too heavy into these SPACs, the high growth stocks, the YouTube stocks. And I get it. YouTube's exciting. These stocks are super exciting. Kathy Wood's tweeting, or Elon's tweeting some, Dogecoin, and Kathy's buying all these SPACs, and people are getting excited, going all into the high risk, high growth stuff. And at the end of the day, guys, that's a double-edged sword, because now we're going to look at some SPACs here. Yeah, you can make a lot of money with those, but when the market, and the market hasn't even turned down, that's the funny thing. But when these SPACs, when these high growth stocks, whatever you want to call them, they don't do well, and you're too heavy in them, and you don't have diversification, you're not going to do well, obviously. And that's why a lot of these people are leaving comments, Stas, I'm down, what do I do? The truth is, you're probably too over-allocated. You're over-allocated to these stocks, and some of them are still, they SPAC'd already. Some of them already went through the merging process. But, one of them is Open Door. Open Door and Chamath Palihapitiya, he brought a lot of these SPACs to market. A lot of people, including myself, we were making money on Open Door, right? This went from $10 to $40. Now it's down to $18. So if you were holding this from the past couple of weeks, you're down 50% as the S&P is hitting highs, Dow's hitting highs, NASDAQ's hitting highs. Open Door, down 50%. IPOE is another one, right? This is Chamath's as well. This went from 10 to 28. Now it's at 16. This one's down about 40% over the past couple of months, ever since the beginning of February. We also have Lordstown Motors. Don't even get me started on this one, guys. They got a short report from Hindenburg published a couple weeks ago, and ever since then, it's just been a disaster. I mean, Lordstown Motors went from $32. Now it's at $9. It's down 70% pretty much. We have QS TDS QuantumScape. This one is down from $138. This is what I'm talking about, guys. This is the problem. People are they're so used to the crypto, Dogecoin going up, these SPACs going up hundreds of percent, thousands of percent, and they think this is the normal. But sorry to tell you this, I don't want to be a Debbie Downer. I'm just a realistic guy. It's just not the case. I mean, this is not going to happen all the time, guys. It's rare we see this type of stuff happening. This went from $20 to $140, right? What was that? A 7x? I can't even count in my head. That is how big of a move that was. And now it's down to $35. It's down 75%. Now, could you imagine if you were heavy into these SPACs? All in, right? Your whole portfolio, you would be screwed. No wonder why people are losing a lot of money. And I'm not trying to be an a-hole to you guys. I'm not trying to piss you off. I'm just trying to, give it to you straight here. And you can own SPACs, no doubt about it. I'm not being a hypocrite here. In fact, I own SPACs myself, right? And some of these already went through the merger. We'll talk about that in a second. But first, let's look at some of these other SPACs that have been going down. Fisker down 3% on Friday, but it's down from $32. Now it's at $13. It's down 60%, right? SRAC, which is one that I made a video on a couple months ago at $10, right? It went to $30 at 300%. It had a 300% increase, and now it's back to $10, right? It lost all of that. It dropped 65%. We have Arrival, ARVL, guys. Take a look at this one. Arrival went up 8% on Friday. That's nice, but it's still down 65% from its peak here at $37. So, yeah, like I said, SPACs, they're good, but they're risky. And the way you should do this, and I'm not a financial advisor, so I shouldn't really say what you should do, but you really should think about, let's put it this way, you really should think about the way you're constructing your portfolio, right? How are you constructing it? Are you building a core foundation of blue chip companies and then building your speculative holdings around it? That's kind of what I'm doing, and I believe that's the right way to go. And this is a way that you can weather the storm when the SPACs hit the fan, when they get crushed, because you still have that core base, right? So for me, let's say my biggest or my most favorite 5 stocks, my core 5 stocks, let's say, for example, and I do own all of these: Apple, Google, Amazon, MasterCard, right? Johnson & Johnson. These are core stocks I own, and I build my speculative plays around them. And let's say percentage-wise, I have most of my money in stocks that are not too risky, not too speculative. And yes, there's risk with every stock in the market, but I'm heavy in, and you guys know this because I talk about this all the time, I'm heavy in my core stocks, and then I trade around it, right? I swing trade, I day trade as well, and I do speculative stuff around the core. That is what you guys have to understand. And if you built your portfolio that way, you're not down now. In fact, you're up a ton, like I said, because the S&P, the Dow, the NASDAQ, everything is at all-time highs. So when I see people commenting, oh, I'm getting crushed, you're just too heavy in the speculative plays. That is just the truth. And I own these speculative plays. I own some, and I don't think these are too speculative. I picked ones that I believe, they have a product, they're making money right now, and I believe these will succeed over time. I own Tattooed Chef, right? This was a SPAC, and this one's still down. Mind you, a lot of these are still down. Tattooed Chef is down about 35% from its high, and I've been buying this one from $24, $23. I just bought more this week at $18.50 roughly. So TTCF I own. GNOG is another one. GNOG. I believe this was ticker symbol LCA before the merger went through. And this is one that I recently started buying as well. This is Golden Nugget Online Gaming. I made a whole video on this company. I'll link it down below. This company is growing quick, right? Has a lot of growth ahead of it, in my opinion. And as states legalize online gaming and iGaming, which is what GNOG is going after for the most part, this is going to do well, and it's expanding. It's in a couple states now. It's going to get to 10, 15 states over time, 20 states even. Who knows how many, but all I know is that it's continuing to expand, so I want some GNOG, and GNOG's down a lot. It's down more than Tattooed Chef from Tattooed Chef's peak. GNOG is down about 50%, so I own some of these guys. I also own DraftKings. I just bought this one recently as well, a couple days ago, right? DraftKings I own, and I plan on buying more of this stock on the dip. And ChargePoint, CHPT, this was also a SPAC, right? This was, it used to be, what was it? SBE, Switchback Energy. You guys remember that? This went from $10 to $50. Now it's down to $22. So this one's down about 60%. And this is one that I plan on buying more of. And I don't want to keep you guys too long. We're about 10 minutes in. Yeah, about 10 minutes in. You guys get the point here, right? And you must understand a lot of these, they're volatile. So if you don't want to have your portfolio swinging up and down like crazy, allocate maybe 5%, 10% of your portfolio to SPACs, and then the other 90% could be in blue chip stocks, more established companies. At least that's how I'm doing it, me personally, right? And it's all relative. You have to ask yourself what your risk tolerance is. Do you want to buy 50% SPACs, 50% more core blue chip holdings, or do you want to go all in SPACs? I mean, at the end of the day, you can do whatever you want. I'm just telling you all, if you're down a lot and the markets are at all-time highs, could you imagine what's going to happen to those holdings when the market drops? If the S&P 500, and this is a good point to end the video off, if the S&P 500 dropped 20% and your SPACs are already down 70% from the high, QuantumScape, IPOE, Lordstown Motors, these could go down 90% from their highs, right? They could drop even more. Let's say QuantumScape. Okay, we'll end off here. QuantumScape's down 75% from its high right now, and the S&P's at an all-time high. Let's say S&P 500 drops 20%. QuantumScape might go down to $10. Straight up, guys. It might go to $15, $20 a share. Don't be surprised if that were to happen, right? Because, again, I can't say this enough. These SPACs are struggling as the markets are at all-time highs. Keep that in mind, and we'll just end it off there. And again, guys, I'm not a financial advisor. Do your own research. This is simply just my opinion. So if you all enjoyed it, hit the like button. Make sure to subscribe if you want to see further content like this. I'm keeping it real. If you guys don't like that, I don't know what to tell you at the end of the day. I don't don't know what to tell you. But yeah, hope you all enjoyed the video. Check out my Patreon down below for buy and sell alerts, call outs, morning update videos. You guys could also get $30 free from M1 Finance. All you have to do is deposit $100 using my link down below, and you get $30. And you could also get $10 free as well from Coinbase. Again, all of those are linked down below. So I'll catch you all in the next video. Hope you all found some value in this. Stay safe out there. Keep crushing the markets, guys. Peace out.